When we think about options, we usually think about investment strategies or portfolio management strategies, but options have a number of applications in corporate finance. Now, you should recall that an option gives the holder of the option the right but not the obligation to do something. If it gives them the right to buy, then it's a call option. If it gives them the right to sell, it's considered a put option. And they can buy or sell, depending on what type of option it is, a specified number of shares at a specific price known as the exercise price during some specific time period. Now, a number of applications to corporate finance include valuing the firm, risk management, compensation plans, and warrants. So let's take a look at some of these. But first, let's recall what the payoff to options look like. If you buy a call option, the payoff picture looks like this. It's this sort of hockey stick look. There's an exercise price here. For example, say it's 50. If the price is below 50, the call option gives you the right to buy at 50, but if it's below a price of 50, there's no reason to use it. Say the price is $40 a share. Then if you want to own the shares of a stock, just go out in the marketplace and buy them for 40. There's no value to buying them for a price of 50. And so all you lose is the premium you paid here, okay? Whatever price you paid for the option. You just let it expire worthless. Now, if the price goes above the exercise price, then the option has value. For example, if the price goes to $70 a share, you can buy it at 50 and sell it at 70 and you can make some money. So there it would be valuable to exercise your option. The payoff picture for a put option looks like this. A put option gives you the right to sell at the exercise price. Now, you're going to do that when the price falls. Now, if the price is above the exercise price, so say the exercise price is 100, if the stock price is selling for 120, there's no reason to sell it for 100. You should just go into the marketplace and sell it for 120. But if the price falls to $50 a share, you can still sell it at 100 and realize a profit. So here's where, again, the option is valuable. Okay, it's the option holder's choice as to whether to use it or not. So if the price in the case of a put option goes up, goes above the exercise price, all you lose is a premium. So one application here is in valuing a firm. Now, if you think about it, if you own stock in a firm, you own a residual claim. You're entitled to whatever the firm is worth after everybody gets paid off. So if the value of the firm exceeds the value of debt, then equity holders have value. If the value of the firm is below the value of debt, then essentially the company's not worth anything and you just declare bankruptcy. Okay? So in the case of having value that's above the value of debt, there's real value to equity holders. In fact, what this does sometimes is it encourages management to take risks, because if they engage in a risky business strategy, if the company doesn't do well, the company goes bankrupt. But if the company goes if the value of the firm goes way up because the business venture is successful, then the value of equity goes up a lot. So sometimes it encourages management to behave sometimes in a reckless manner. If you've studied option pricing, and I have videos on that, you know that greater risk is associated with greater option value. Another application is in risk management. For example, suppose a firm is thinking about issuing bonds sometime in the future. Now, we know that when interest rates go up, the price of bonds goes down. So the firm may protect itself in terms of how much it will receive when it issues the bonds at some later date by using a put option. So if interest rates go up, the price of the bonds goes down, they exercise their option, and that offsets some of their loss. So they're able to hedge rising interest rates using option strategies. In risk management, insurance is oftentimes thought of as an option. So you have the value of an asset. You've insured your home. You've insured the value of your car. What's the exercise price? Essentially, it's the deductible. So, for example, if you have an auto insurance policy and the deductible is $500, if you get into an accident and the damage is $375, you don't exercise the option. But on the other hand, if the accident exceeds that so that you're losing enough value, it may be worth exercising the option. So if the value of if your loss is greater than $500, you have $2,000 worth of damage to your car, you'll exercise the option, and the value of the policy is worth something. Okay? If there's no accident, or the policy or the damage to the car is less than the deductible, then you just let the policy expire worthless. Executive compensation plans. It's very common for top executives to receive stock options. Okay? These are call options. It allows them to purchase shares of the stock at a pre-specified price. So if the executives can raise the value of the firm, they can profit from an increased value of their options. If the value of the firm goes down or doesn't rise, the options become worthless. So it's oftentimes used to provide an incentive for management to work to increase the value of the shares. Okay? This is to deal with the so-called agency problem, where oftentimes executives may not behave in the best interest of shareholders. Okay? One problem, though, goes back to one of the first slides I showed, which is the value of the firm. If executives have a lot of these stock options, they may have an incentive to take a lot of risk. If they take a lot of risk and the value of the stock goes up a lot because the ventures they engaged in did well, then the value of their options go up a lot. If, on the other hand, the company goes bankrupt, well, the options just expire worthless. Okay, finally, let me mention something referred to as a warrant. A warrant is a call option issued by the firm. They give the holder the right, again, but not the obligation, to purchase shares of the firm's stock directly from the firm at the exercise price. So it's a call option. Firms may use them to sweeten some sort of bond offering, perhaps by giving bondholders some warrants in addition to the bonds. Bondholders may be willing to accept a lower interest rate because if the value of the stock goes up, they can cash in the warrants and benefit from this upside. And during the 2008 and 2009 financial crisis, Warren Buffett purchased $5 billion of Goldman Sachs preferred stock, but he also received a number of warrants that gave him the right, again, but not the obligation, to buy shares of Goldman Sachs at some pre-specified price. And again, this made it a much more attractive deal for Mr. Buffett. So you can see that options have a lot of applications, not just in investments and portfolio management, but also in corporate finance.